etc., as previously discussed. Corresponding adjustments in book values or current asset values per share of common stock should be made in analyzing the balance sheet. This technique is followed in our discussion of the Baldwin Locomotive Works exhibit in the appendix, in which outstanding warrants are allowed for. Allowances for participating interests. In calculating the earnings available for the common, full recognition must be given to the rights of holders of participating issues, whether or not the amounts involved are actually being paid thereon. Similar allowances must be made for the effective management contracts providing for a substantial percentage of the profits as compensation, as in the case of investment trusts. Unusual cases sometimes arise involving restricted shares, dividends on which are contingent upon earnings or other considerations. Example: Trico Products Corporation, a large manufacturer of automobile accessories, is capitalized at 675,000 shares of common stock, of which 450,000 shares owned by the president were originally restricted as to dividends. The unrestricted stock is first entitled to dividends of $2.50 per share, after which both classes share equally in further dividends. In addition, successive blocks of the restricted stock were to be released from the restriction according as the earnings for 1925 and successive years reached certain stipulated figures. To the end of 1938, a total of 239,951 shares had been thus released. In the table that may be found in the accompanying PDF, column C supplies the soundest measure of the earning power shown for the unrestricted shares. Column A is irrelevant. A situation similar to that in Trico Products Corporation obtained in the case of Montana Power Company stock prior to June 1921. General rule. The material in the last few pages may be summarized in the following general rule. The intrinsic value of a common stock preceded by convertible securities or subject to dilution through the exercise of stock options or through participating privileges enjoyed by other security holders cannot reasonably be appraised at a higher figure than would be justified if all such privileges were exercised in full. Chapter 40. Capitalization Structure. The division of a company's total capitalization between senior securities and common stock has an important bearing upon the significance of the earning power per share. A set of hypothetical examples will help make this point clear. For this purpose, we shall postulate three industrial companies, A, B, and C, each with an earning power, that is, with average and recent earnings, of $1 million. They are identical in all respects save capitalization structure. Company A is capitalized solely at 100,000 shares of common stock. Company B has outstanding $6 million of 4% bonds and 100,000 shares of common stock. Company C has outstanding $12 million of 4% bonds and 100,000 shares of common stock. We shall assume that the bonds are worth par and that the common stocks are worth about 12 times their per share earnings. Then the value of the three companies will work out as follows. Company A, earnings for common stock $1 million, value of common stock $12 million, total value of company $12 million. Company B, earnings for common stock $760,000, value of common stock $9 million, value of bonds $6 million, total value of company $15 million. Company C, earnings for common stock $520,000, value of common stock $6 million, value of bonds $12 million, total value of company $18 million. These results challenge attention. Companies with identical earning power appear to have widely differing values due solely to the arrangement of their capitalization. But the capitalization structure is itself a matter of voluntary determination by those in control. Does this mean that the fair value of an enterprise can be arbitrarily increased or decreased by changing around the relative proportions of senior securities and common stock? Can the value of an enterprise be altered through arbitrary variations in capital structure? To answer this question properly, we must scrutinize our examples with greater care. In working out the value of the three companies, we assumed that the bonds would be worth par and that the stocks would be worth 12 times their earnings. Are these assumptions tenable? Let us consider first the case of Company B. If there are no unfavorable elements in the picture, the bonds might well sell at about 100, since the interest is earned 4 times. Nor would the presence of this funded debt ordinarily prevent the common stock from selling at 12 times its established earning power. It will be urged, however, that if Company B shares are worth 12 times their earnings, Company A shares should be worth more than this multiple because they have no debt ahead of them. The risk is therefore smaller, and they are less vulnerable to the effect of a shrinkage in earnings than is the stock of Company B. This is obviously true, and yet it is equally true that Company B shares will be more responsive to an increase in earnings. The following figures, which may be found in the accompanying PDF, bring this point out clearly. Would it not be fair to assume that the greater sensitivity of Company B to a possible decline in profits is offset by its greater sensitivity to a possible increase? Furthermore, if the investor expects higher earnings in the future, and presumably he selects his common stocks with this in mind, would he not be justified in selecting the issue that will benefit more from a given degree of improvement? We are thus led back to the original conclusions that Company B may be worth $3 million or 25% more than Company A due solely to its distribution of capitalization between bonds and stock. Principle of optimum capitalization structure. Paradoxical as this conclusion may seem, it is supported by the actual behavior of common stocks in the market. If we subject this contradiction to closer analysis, we shall find that it arises from what may be called an oversimplification of Company A's capital structure. Company A's common stock evidently contains the two elements represented by the bonds and stock of Company B. Part of Company A's stock is at bottom equivalent to Company B's bonds and should, in theory, be valued on the same basis, that is, 4%. The remainder of Company A's stock should then be valued at 12 times earnings. This theoretical reasoning would give us a combined value of $15 million, that is, an average 6 2/3% basis for the two components of Company A stock, which of course is the same as that of Company B bonds and stock taken together. But this $15 million value for Company A stock would not ordinarily be realized in practice. The obvious reason is that the common stock buyer will rarely recognize the existence of a bond component in a common stock issue, and in any event, not wanting such a bond component, he is unwilling to pay extra for it. This fact leads us to an important principle both for the security buyer and for corporate management, viz., the optimum capitalization structure for any enterprise includes senior securities to the extent that they may safely be issued and bought for investment. Concretely, this means that the capitalization arrangement of Company B is preferable to that of Company A from the stockholder's standpoint, assuming that in both cases the $6 million bond issue would constitute a sound investment. This might require, among other things, that the company show a net working capital of not less than $6 million in accordance with the stringent test for sound industrial issues recommended in Chapter 13. Under such conditions, the contribution of the entire capital by the common stockholders may be called an over-conservative setup, as it tends generally to make the stockholder's dollar less productive to him than if a reasonable part of the capital were borrowed. An analogous situation holds true in most private businesses where it is recognized as profitable and proper policy to use a conservative amount of banking accommodation for seasonal needs rather than to finance operations entirely by owner's capital. Corporate practices resulting in shortage of sound industrial bonds. Furthermore, just as it is desirable from the bank's standpoint that sound businesses borrow seasonally, it is also desirable from the standpoint of investors generally that strong industrial corporations raise an appropriate part of their capital through the sale of bonds. Such a policy would increase the number of high-grade bond issues on the market, giving the bond investor a wider range of choice and making it deservedly difficult to sell unsound bonds. Unfortunately, the practice of industrial corporations in recent years has tended to produce a shortage of good industrial bond issues. Strong enterprises have, in general, refrained from floating new bonds and in many cases have retired old ones. But this avoidance of bonded debt by the strongest industrial companies has, in fact, produced results demoralizing to investors and investment policies in a number of ways. The following observations on this point, written in 1934, are still applicable in good part. 1. It has tended to restrict new industrial bond financing to companies of weaker standing. The relative scarcity of good bonds impelled investment houses to sell and investors to buy inferior issues with inevitably disastrous results. 2. The shortage of good bonds also tended to drive investors into the preferred stock field. For reasons previously detailed in Chapter 14, straight preferred stocks are unsound in theory, and they are therefore likely to prove unsatisfactory investment media as a class. 3. The elimination or virtual elimination of senior securities in the setup of many large corporations has, of course, added somewhat to the investment quality of their common stocks, but it has added even more to the investors' demand for these common stocks. This in turn has resulted in a good deal of common stock buying by people whose circumstances required that they purchase sound bonds. Furthermore, it has supplied a superficial justification for the creation of excessive prices for these common stocks, and finally, it contributed powerfully to that confusion between investment motives and speculative motives, which, during 1927 to 1929, served to debauch so large a proportion of the country's erstwhile careful investors. Appraisal of earnings where capital structure is top-heavy. In order to carry this theory of capitalization structure a step further, let us examine the case of Company C. We arrived at a valuation of $18 million for this enterprise by assuming that its $12 million bond issue would sell at par and the stock would sell for 12 times its earnings of $5.20 per share. But this assumption as to the price of the bonds is clearly fallacious. Earnings of twice interest charges are not sufficient protection for an industrial bond, and hence investors would be unwise to purchase such an issue at par. In fact, this very example supplies a useful demonstration of our contention that a coverage of 2 times interest is inadequate. If it were ample, as some investors seem to believe, the owners of any reasonably prosperous business, earning 8% on the money invested, could get back their entire capital by selling a 4% bond issue, and they would still have control of the business together with 1/2 of its earnings. Such an arrangement would be exceedingly attractive for the proprietors, but idiotic from the standpoint of those who buy the bonds. Our Company C example also sheds some light on the effect of the rate of interest on the apparent safety of the senior security. If the $12 million bond issue had carried a 6% coupon, the interest charges of $720,000 would then be earned less than 1.5 times. Let us assume that Company D had such a bond issue. An unwary investor looking at the two exhibits might reject Company D's 6% bonds as unsafe because their interest coverage was only 1.39, but yet accept the Company C bonds at par because he was satisfied with earnings of twice fixed charges. Such discrimination would be scarcely intelligent. Our investor would be rejecting a bond merely because it pays him a generous coupon rate, and he would be accepting another bond merely because it pays him a low interest rate. The real point, however, is that the minimum margin of safety behind bond issues must be set high enough to avoid the possibility that safety may even appear to be achieved by a mere lowering of the interest rate. The same reasoning would apply, of course, to the dividend rate on preferred stocks. Since Company C bonds are not safe because of the excessive size of the issue, they are likely to sell at a considerable discount from par. We cannot suggest the proper price level for such an issue, but we have indicated in Chapter 26 that a bond speculative because of inadequate safety should not ordinarily be purchased above 70. It is also quite possible that the presence of this excessive bond issue might prevent the stock from selling at 12 times its earnings, because conservative stock buyers would avoid Company C as subject to too great hazard of financial difficulties in the event of untoward developments. The result may well be that, instead of being worth $18 million in the market as originally assumed, the combined bond and stock issues of Company C will sell for less than $15 million, the Company B valuation, or even for less than $12 million, the value of Company A. As a matter of cold fact, it should be recognized that this unfavorable result may not necessarily follow. If investors are sufficiently careless and if speculators are sufficiently enthusiastic, the securities of Company C may conceivably sell in the market for $18 million or even more. But such a situation would be unwarranted and unsound. Our theory of capitalization structure could not admit a Company C arrangement as in any sense standard or suitable. This indicates that there are definite limits upon the advantages to be gained by the use of senior securities. We have already expressed this fact in our principle of the optimum capitalization structure, for senior securities cease to be an advantage at the point where their amount becomes larger than can safely be issued or bought for investment. We have characterized the Company A type of capitalization arrangement as over-conservative. The Company C type may be termed speculative, whereas that of Company B may well be called suitable or appropriate. The factor of leverage in speculative capitalization structure. Although a speculative capitalization structure throws all the company's securities outside the pale of investment, it may give the common stock a definite speculative advantage. A 25% increase in the earnings of Company C, from $1 million to $1,250,000, will mean about a 50% increase in the earnings per share of common, from $5.20 to $7.70. Because of this fact, there is some tendency for speculatively capitalized enterprises to sell at relatively high values in the aggregate during good times or good markets. Conversely, of course, they may be subject to a greater degree of undervaluation in depression. There is, however, a real advantage in the fact that such issues, when selling on a deflated basis, can advance much further than they can decline. The record of American Water Works and Electric Company common stock between 1921 and 1929 presents an almost fabulous picture of enhancement in value, a great part of which was due to the influence of a highly speculative capitalization structure. 4 annual exhibits during this period are summarized in the table that may be found in the accompanying PDF. The purchaser of 1 share of American Water Works common stock at the high price of $6.50 in 1921, if he retained the distributions made in stock, would have owned about 12.5 shares when the common sold at its high price of $1.99 in 1929. His $6.50 would have grown to about $2,500. While the market value of the common shares was thus increasing some 400-fold, the gross earnings had expanded to only 2.6 times the earlier figure. The tremendously disproportionate rise in the common stock value was due to the following elements in order of importance. 1. A much higher valuation placed upon the per-share earnings of this issue. In 1921, the company's capitalization was recognized as top-heavy. Its bonds sold at a low price, and the earnings per share of common were not taken seriously, especially since no dividends were being paid on the second preferred. In 1929, the general enthusiasm for public utility shares resulted in a price for the common issue of nearly 50 times its highest recorded earnings. 2. The speculative capitalization structure allowed the common stock to gain an enormous advantage from the expansion of the company's properties and earnings. Nearly all the additional funds needed were raised by the sale of senior securities. It will be observed that whereas the gross revenues increased about 160% from 1921 to 1929, the balance per share of old common stock grew 14-fold during the same period. 3. The margin of profit improved during these years as shown by the higher ratio of net to gross. The speculative capital structure greatly accentuated the benefit to the common stock from the additional net profits so derived. Other examples. The behavior of speculatively capitalized enterprises under varying business conditions is well illustrated by the appended analysis of A.E. Staley Manufacturing Company, manufacturers of corn products. For comparison, there is given also a corresponding analysis of American Maize Products Company, a conservatively capitalized enterprise in the same field. The most striking aspect of the Staley exhibit is the extraordinary fluctuation in the yearly earnings per share of common stock. The business itself is evidently subject to wide variations in net profit, and the effect of these variations on the common stock is immensely magnified by reason of the small amount of common stock in comparison with the senior securities. The large depreciation allowance acts also as the equivalent of a heavy fixed charge. Hence, a decline in net before depreciation from $3,266,000 in 1929 to $1,540,000 the next year, somewhat over 50%, resulted in a drop in earnings per share of common from $84 to only $3.74. The net profits of American Maize products were fully as variable, but the small amount of prior charges made the fluctuations in common stock earnings far less spectacular. These comparative figures may be found in the accompanying PDF. Speculative capitalization may cause valuation of total enterprise at an unduly low figure. The market situation of the Staley securities in January 1933 presents a practical confirmation of our theoretical analysis of Company C above. The top-heavy capitalization structure resulted in a low price for the bonds and the preferred stock, the latter being affected particularly by the temporary suspension of its dividend in 1931. The result was that, instead of showing an increased total value by reason of the presence of senior securities, the company sold in the market at a much lower relative price than the conservatively capitalized American Maize products. The latter company showed a normal relationship between average earnings and market value. It should not properly be termed over-conservatively capitalized because the variations in its annual earnings would constitute a good reason for avoiding any substantial amount of senior securities. A bond or preferred stock issue of very small size, on the other hand, would be of no particular advantage or disadvantage. The indication that the A.E. Staley Company was undervalued in January 1933 in comparison with American Maize products is strengthened by reference to the relative current asset positions and total resources. Per dollar of net asset values, the Staley Company was selling only one-third as high as American Maize. The overdeflation of a speculative issue like Staley Common in unfavorable markets creates the possibility of an amazing price advance when conditions improve, because the earnings per share then show so violent an increase. Note that at the beginning of 1927, Staley Common was quoted at about 75, and a year later it sold close to 300. Similarly, the shares advanced from a low of 33 in 1932 to the equivalent of 320 in 1939. A corresponding example. A more spectacular instance of tremendous price changes for the same reason is supplied by Mohawk Rubber. In 1927, the common sold at 15, representing a valuation of only $300,000 for the junior issue, which followed $1,960,000 of preferred. The company had lost $610,000 in 1926 on $6,400,000 of sales. In 1927, sales dropped to $5,700,000, but there was a net profit of $630,000. This amounted to over $23 per share on the small amount of common stock. The price consequently advanced from its low of 15 in 1927 to a high of $251 in 1928. In 1930, the company again lost $669,000, and the next year the price declined to the equivalent of only $4. In a speculatively capitalized enterprise, the common stockholders benefit or have the possibility of benefiting at the expense of the senior security holders. The common stockholder is operating with a little of his own money and with a great deal of the senior security holder's money, as between him and them it is a case of heads I win, tails you lose. This strategic position of the common stockholder with relatively small commitment is an extreme form of what is called trading on the equity. Using another expression, he may be said to have a cheap call on the future profits of the enterprise. Speculative attractiveness of shoestring common stocks considered. Our discussion of fixed value investment has emphasized as strongly as possible the disadvantage, amounting to unfairness, that attaches to the senior security holder's position where the junior capital is proportionately slight. The question would logically arise if there are not corresponding advantages to the common stock in such an arrangement, from which it gains a very high degree of speculative attractiveness. This inquiry would obviously take us entirely outside the field of common stock investment, but would represent an expedition into the realm of intelligent or even scientific speculation. We have already seen from our A.E. Staley example that in bad times a speculative capitalization structure may react adversely on the market price of both the senior securities and the common stock. During such a period, then, the common stockholders do not derive a present benefit at the expense of the bondholder. This fact clearly detracts from the speculative advantage inherent in such common stocks. It is easy to suggest that these issues be purchased only when they are selling at abnormally low levels due to temporarily unfavorable conditions. But this is really begging the question because it assumes that the intelligent speculator can consistently detect and wait for these abnormal and temporary conditions. If this were so, he could make a great deal of money regardless of what type of common stock he buys, and under such conditions, he might be better advised to select high-grade common stocks at bargain prices rather than these more speculative issues. Practical aspects of the foregoing. To view the matter in a practical light, the purchase of speculatively capitalized common stocks must be considered under general or market conditions that are supposedly normal. That is, under those which are not obviously inflated or deflated. Assuming 1. Diversification, and 2. Reasonably good judgment in selecting companies with satisfactory prospects, it would seem that the speculator should be able to profit rather substantially in the long run from commitments of this kind. In making such purchases, partiality should evidently be shown to those companies in which most of the senior capital is in the form of preferred stock rather than bonds. Such an arrangement removes or minimizes the danger of extinction of the junior equity through default in bad times, and thus permits the shoestring common stockholder to maintain his position until prosperity returns. But just because the preferred stock contract benefits the common shareholder in this way, it is clearly disadvantageous to the preferred stockholder himself. We must not forget, however, the peculiar practical difficulty in the way of realizing the full amount of prospective gain in any one of the purchases. As we pointed out in the analogous case of convertible bonds, as soon as a substantial profit appears, the holder is in a dilemma, because he can hold for further gain only by risking that already accrued. Just as a convertible bond loses its distinctive advantages when the price rises to a point that carries it clearly outside of the straight investment class, so a shoestring common stock commitment is transformed into a more and more substantial commitment as the price continues to rise. In our Mohawk rubber example, the intelligent purchaser at 15 could not have expected to hold it beyond 100, even though its quotation did reach 250. Because at 100 or before, the shares had lost the distinctive characteristics of a speculatively capitalized junior issue. Chapter 41. Low-priced common stocks. Analysis of the source of income. Low-priced stocks. The characteristics discussed in the preceding chapter are generally thought of by the public in connection with low-priced stocks. The majority of issues of the speculatively capitalized type do sell within the low-priced range. The definition of low-priced must, of course, be somewhat arbitrary. Prices below $10 per share belong to this category beyond question. Those above $20 are ordinarily excluded, so that the dividing line would be set somewhere between $10 and $20. Arithmetical advantage of low-priced issues. Low-priced common stocks appear to possess an inherent arithmetical advantage arising from the fact they can advance so much more than they can decline. It is a commonplace of the securities market that an issue will rise more readily from 10 to 40 than from 100 to 400. This fact is due in part to the preferences of the speculative public, which generally is much more partial to issues in the 10 to 40 range than to those selling above 100. But it is also true that in many cases low-priced common stocks give the owner the advantage of an interest in or call upon a relatively large enterprise at relatively small expense. A statistical study of the relative price behavior of industrial stocks in various price groups was presented in the April 1936 issue of the Journal of Business of the University of Chicago. The study was devoted to the period 1926 to 1935 and revealed a continuous superiority of diversified, low-priced issues over diversified, high-priced issues as speculative media. The following quotation from the study summarizes the results and conclusions reached by the author. Unless there are serious uncompensated errors in the statistical work here presented, this investigation would seem to establish the existence of certain relationships between price level and price fluctuations which have hitherto gone unreported by students of stock market phenomena. These relationships may be briefly stated as follows. 1. Low-price stocks tend to fluctuate relatively more than high-price stocks. 2. In a bull market, the low-price stocks tend to go up relatively more than high-price stocks, and they do not lose these superior gains in the recessions which follow. In other words, the downward movement of low-price stocks is less than proportional to their upward movement when compared with the upward and downward movement of high-price stocks. Assuming, 1, that the future behavior of the various price groups will be similar to their past behavior, and 2, that the selection of stocks on the basis of the activity for the current year does not account completely, if at all, for the superior performance of the stocks in the low price groups, it seems logical to conclude the following. 1. Low-price industrial stocks offer greater opportunities for speculative profits than high-price industrial stocks. 2. In case 2 or more issues of industrial stocks seem to offer equal prospective profits, the speculator should purchase the shares selling at the lowest price. Some reasons why most buyers of low-priced issues lose money. The pronounced liking of the public for cheap stocks would therefore seem to have a sound basis in logic. Yet it is undoubtedly true that most people who buy low-priced stocks lose money on their purchases. Why is this so? The underlying reason is that the public buys issues that are sold to it, and the sales effort is put forward to benefit the seller and not the buyer. In consequence, the bulk of the low-priced purchases made by the public are of the wrong kind. That is, they do not provide the real advantages of this security type. The reason may be either because the companies are in bad financial condition or because the common stock is low-priced in appearance only and actually represents a full or excessive commitment in relation to the size of the enterprise. The latter is preponderantly true of new security offerings in the low-priced range. In such cases, a pseudo-low price is accomplished by the simple artifice of creating so large a number of shares that even at a few dollars per share, the total value of the common issue is excessive. This has been true of mining stock flotations from of old and was encountered again in the liquor stock offerings of 1933 and in the airplane issues in 1938 to 1939. A genuinely low-priced common stock will show an aggregate value for the issue which is small in relation to the company's assets, sales, and past or prospective profits. The example shown herewith will illustrate the difference between a genuine and pseudo low price. These examples may be found in the accompanying PDF. The Wright-Hargreaves issue was low-priced in appearance only, for in fact the price registered a very high valuation for the company as compared with all parts of its financial exhibit. The opposite was true of Barker Brothers, because here the $743,000 valuation represented by the common stock was exceedingly small in relation to the size of the enterprise. Note also that the same statement could be applied to Barker Brothers Preferred, which at its quotation of 18 partook of the qualities of a low-priced common stock. Observation of the stock market will show that the stocks of companies facing receivership are likely to be more active than those which are very low in price merely because of poor current earnings. This phenomenon is caused by the desire of insiders to dispose of their holdings before the receivership wipes them out, thus accounting for a large supply of these shares at a low level, and also sometimes for unscrupulous efforts to persuade the unwary public to buy them. But where a low-priced stock fulfills our conditions of speculative attractiveness, there is apt to be no pressure to sell and no effort to create buying. Hence, the issue is inactive and attracts little public attention. This analysis may explain why the public almost always buys the wrong low-priced issues and ignores the really promising opportunities in this field. Low price coupled with speculative capitalization. Speculatively capitalized enterprises, according to our definition, are marked by a relatively large amount of senior securities and a comparatively small issue of common stock. Although in most cases the common stock will sell at a low price per share, it need not necessarily do so if the number of shares is small. In the Staley case, for example, referred to in the previous chapter, even at $50 per share for the common in 1933, the capitalization structure would still have been speculative, since the bonds and preferred at par would represent over 90% of the total. It is also true that even where there are no senior securities, the common stock may have possibilities equivalent to those in a speculatively capitalized enterprise. These possibilities will occur wherever the market value of the common issue represents a small amount of money in relation to the size of the business, regardless of how it is capitalized. To illustrate this point, we append a condensed analysis of Mandel Brothers, Inc. and Gimbel Brothers, Inc., two department store enterprises, as of September 1939. This comparison may be found in the accompanying PDF. Gimbel Brothers presents a typical picture of a speculatively capitalized enterprise. On the other hand, Mandel Brothers has no senior securities ahead of the common. But despite this fact, the relatively small market value of the entire issue imparts to the shares the same sort of speculative possibilities, though in somewhat lesser degree, as are found in the Gimbel Brothers setup. Note, however, that the rental payments of Mandel Brothers are proportionately much higher than those of Gimbel Brothers, and that these rental charges are equivalent in good part to senior securities. Large volume and high production cost equivalent to speculative capital structure. This example should lead us to widen our conception of a speculatively situated common stock. The speculative or marginal position may arise from any cause that reduces the percentage of gross available for the common to a subnormal figure, and that therefore serves to create a subnormal value for the common stock in relation to the volume of business. Unusually high operating or production costs have the identical effect as excessive senior charges in cutting down the percentage of gross available for common. The following hypothetical examples of three copper producers, found in the accompanying PDF, will make this point more intelligible and also lead to some conclusions on the subject of large output versus low operating costs. It is scarcely necessary to point out that the higher production cost of Company C will have exactly the same effect as the bond interest requirement of Company B, assuming output and production costs to continue as stated. General principle derived. The foregoing table is perhaps more useful in showing concretely the inverse relationship that usually exists between profit per unit and output per dollar of stock value. The general principle may be stated that the lower the unit cost, the lower the production per dollar of market value of stock, and vice versa. Since Company A has a 7-cent cost, its stock naturally sells at a higher price per pound of output than Company C with its 9-cent cost. Conversely, Company C produces more pounds per dollar of stock value than Company A. This fact is not without significance from the standpoint of speculative technique. When a rise in the price of the commodity occurs, there will ordinarily be a larger advance, percentage-wise, in the shares of high-cost producers than in the shares of low-cost producers. The foregoing table indicates that a rise in the price of copper from 10 to 13 cents would increase the value of Company A shares by 100%, and the value of Company B and C shares by 300%. Contrary to the general impression in Wall Street, the stocks of high-cost producers are more logical commitments than those of the low-cost producers when the buyer is convinced that a rise in the price of the product is imminent and he wishes to exploit this conviction to the utmost. Exactly the same advantage attaches to the purchase of speculatively capitalized common stocks when a pronounced improvement in sales and profits is confidently anticipated. The sources of income. The source of income will ordinarily be thought of as meaning the same thing as the type of business. This consideration enters very largely into the basis on which the public will value the earnings per share shown by a given common stock. Different multipliers are used for different sorts of enterprise, but we must point out that these distinctions are themselves subject to change with the changing times. Prior to the World War, the railroad stocks were valued most generously of all because of their supposed stability. In 1927 to 1929, the public utility group sold at the highest ratio to earnings because of their record of steady growth. Between 1933 and 1939, adverse legislation, and in particular, the fear of government competition, greatly reduced the relative popularity of the utility stocks. The most liberal valuations have recently been accorded to the large and well-entrenched industrial enterprises which were able to maintain substantial earnings during the Depression and are considered to possess favorable long-term prospects. Because of these repeated variations in relative behavior and popularity, security analysis must hesitate to prescribe any definitive rules for valuing one type of business as against another. It is a truism to say that the more impressive the record and the more promising the prospects of stability and growth, the more liberally the per-share earnings should be valued, subject always to our principle that a multiplier higher than about 20, that is, an earnings basis of less than 5%, will carry the issue out of the investment price range. A special phase. 3 examples. A more fruitful field for the technique of analysis is found in those cases where the source of income must be studied in relation to specific assets owned by the company instead of in relation merely to the general nature of the business. This point may be quite important when a substantial portion of the income accrues from investment holdings or from some other fixed and dependable source. 3 examples will be used to eliminate this rather subtle aspect of common stock analysis. 1. Northern Pipeline Company. For the years 1923 to 1925, the Northern Pipeline Company reported earnings and dividends as follows. 1923 net earnings $308,000, $7.70 earned per share, dividend paid $10 plus $15 extra. 1924 $214,000 net earnings, $5.35 earned per share, dividend paid $8. 1925 $311,000 net earnings, earned per share $7.77, dividend paid $6. In 1924, the shares sold as low as 72, in 1925 as low as 67.5, and in 1926 as low as 64. These prices were, on the whole, somewhat less than 10 times the reported earnings and reflected a lack of enthusiasm for the shares due to a pronounced decline in profits from the figures of preceding years and also to the reductions in the dividend. Analysis of the income account, however, would have revealed the following division of the sources of income. These may be found in the accompanying PDF. This income account is exceptional in that the greater part of the profits were derived from sources other than the pipeline business itself. About $4 per share were regularly received in interest on investments and rentals. The balance sheet showed holdings of nearly $3,200,000, or $80 per share, in Liberty bonds and other gilt-edged marketable securities, on which the interest income was about 4%. This fact meant that a special basis of valuation must be applied to the per-share earnings, inasmuch as the usual 10 times earnings basis would result in a nonsensical conclusion. Gilt-edged investments of $80 per share would yield an income of $3.20 per share, and at 10 times earnings, this $80 would be worth only $32 per share, a reductio ad absurdum. Obviously, that part of the Northern Pipeline income that was derived from its bond holdings should logically be valued at a higher basis than the portion derived from the fluctuating pipeline business. A sound valuation of Northern Pipeline stock would therefore have to proceed along the lines suggested below. The pipeline earnings would have to be valued at a low basis because of their unsatisfactory trend. The interest and rental income must presumably be valued on a basis corresponding with the actual value of the assets producing the income. This analysis indicated clearly that, at the price of $64 in 1926, Northern Pipeline stock was selling considerably below its intrinsic value. Northern Pipeline stock valuation. Average 1923 to 1925. Earned per share from pipeline $2.92. Valuation basis 15%, 6 2/3 times earnings. Value per share $20. Earned per share from interest and rentals $4.10. Valuation basis 5%, 20 times earnings. Value per share $80. Total $7.02 earnings. Value per share $100. 2. Lackawanna Securities Company. This company was organized to hold a large block of Glen Alden Coal Company 4% bonds formerly owned by the Delaware, Lackawanna, and Western Railroad Company, and its shares were distributed pro rata to the Delaware, Lackawanna, and Western stockholders. The securities company had outstanding 844,000 shares of common stock. On December 31, 1931, its sole asset, other than about $1 per share in cash, consisted of $51 million face value of Glen Alden 4% first mortgage bonds. For the year 1931, the income account was as follows. Interest received on Glen Alden bonds, $2,084,000. Less expenses, $17,000. Federal taxes, $250,000. Balance for stock, $1,817,000. Earned per share, $2.15. Superficially, the price of 23 in 1932 for a stock earning $2.15 did not appear out of line. But these earnings were derived not from ordinary commercial or manufacturing operations, but from the holding of a bond issue, which presumably constituted a high-grade investment. In 1931, the Glen Alden Coal Company earned $9,550,000 available for interest charges of $2,151,000, thus covering the bond requirements 4.5 times. By valuing this interest income on about a 10% basis, the market was in fact valuing the Glen Alden bonds at only 37 cents on the dollar. The price of 23 for a share of Lackawanna Securities was equivalent to $60 face value of Glen Alden bonds at 37 plus $1 in cash. Here again, as in the Northern Pipeline example, analysis would show convincingly that the customary 10 times earnings basis resulted in a glaring undervaluation of this specially situated issue. 3. Tobacco Products Corporation of Virginia. In this example, as in the other two, the company was selling in the market for about 10 times the latest reported earnings. But the 1931 earnings of tobacco products were derived entirely from a lease of certain of its assets to American Tobacco Company, which provided for an annual rental of $2,500,000 for 99 years from 1923. Since the American Tobacco Company was able to meet its obligation without question, this annual rental income was equivalent to interest on a high-grade investment. Its value was therefore much more than 10 times the income therefrom. This meant that the market valuation of the tobacco product stock issues in December 1931 was far less than was justified by the actual position of the company. The value of the lease was, in fact, calculated to be about $35,600,000 on an amortized basis. The company also owned a large amount of United Cigar Stores stock, which later proved to be practically worthless, but these additional holdings did not, of course, detract from the value of its American tobacco lease. Relative importance of situations of this kind. The field of study represented by the foregoing examples is not important quantitatively because, after all, only a very small percentage of the companies examined will fall within this group. Situations of this kind arise with sufficient frequency, however, to give this discussion practical value. It should be useful also in illustrating again the wide technical difference between the critical approach of security analysis and the highly superficial reactions and valuations of the stock market. Two lines of conduct suggested. When it can be shown that certain conditions, such as those last discussed, tend to give rise to undervaluations in the market, two different lines of conduct are thereby suggested. We have first an opportunity for the securities analyst to detect these undervaluations and eventually to profit from them. But there is also the indication that the financial setup that causes this undervaluation is erroneous and that the stockholders' interests require the correction of this error. The very fact that a company constituted like Northern Pipeline or Lackawanna Securities tends to sell in the market far below its true value proves as strongly as possible that the whole arrangement is wrong from the standpoint of the owners of the business. At the bottom of these cases, there is a basic principle of consistency involved. It is inconsistent for most of the capital of a pipeline enterprise actually to be employed in the ownership of gilt-edged bonds. The whole setup of Lackawanna Securities is also inconsistent because it replaced a presumably high-grade bond issue which investors might be willing to buy at a fair price by a nondescript stock issue which no one would purchase except at an exceptionally low price. In addition, a heavy and needless burden of corporate income tax was involved, as was true in the tobacco products case. Illogical arrangements of this kind should be recognized by the real parties in interest, that is, the stockholders, and they should insist that the anomaly be rectified. This was finally done in the three examples just given. In the case of Northern Pipeline, the capital not needed in the pipeline business was returned to the stockholders by means of special distributions aggregating $70 per share. The Lackawanna Securities Company was entirely dissolved, and the Glen Alden bonds in its treasury distributed pro rata to the stockholders in lieu of their stock. Finally, the Tobacco Products Corporation was recapitalized on a basis by which 6.5% bonds were issued against the American tobacco lease so that this asset of fixed value was represented by a fixed value security, which later were redeemed at par, instead of by shares of stock in a corporation subject to highly speculative influences. By means of these corporate rearrangements, the real values were speedily established in the market price. The situations that we have just analyzed required a transfer of attention from the income account figures to certain related features revealed in the balance sheet. Hence, the foregoing topic, sources of income, carries us over into our next field of inquiry, the balance sheet. Part 6. Balance Sheet Analysis, Implications of Asset Values. Introduction to Part 6. The Evolving Utility of Balance Sheet Analysis by Seth A. Klarman. Early in my career, I took Graham and Dodd quite literally. When they advised close scrutiny of a company's balance sheet to assess value, I regarded that as a mandate. Find companies whose stocks were, for whatever reason, trading for less than the conservatively estimated liquidation value of those firms' underlying assets. Buy them, and then wait for the market to correct the mispricing. This seemed like a no-brainer. But over time, it became increasingly clear to me that this approach was overly simplistic and most of the time unactionable, a null or nearly null set. I realized that Graham himself had expressed the limitations of balance sheet analysis, such as when he said, "The value of a company's assets as carried in its balance sheet has lost practically all its significance, bearing no relationship to the figure at which they would be sold or the figure which would be justified by the earnings." Chapter 42. A lot had changed since Graham's day. Management practices, shareholder activism, the rate of technological innovation, the volume of corporate merger and acquisition activity, rendering a balance sheet-oriented approach to valuation and downside protection much less useful. It is important to examine those changes, but to also see the valuable role that book value still plays in analyzing companies in certain industries and the utility of a balance sheet in understanding the underlying drivers of a business. Security analysis was written in the depths of the Great Depression, at a time when global economic activity had collapsed and the U.S. stock market had plunged more than 80% in only 3 years. This market disarray left enormous carnage in its wake. In a period when not only the future prospects but even the immediate viability of many businesses seemed dim, identifying stocks trading below the liquidation value of the underlying companies was a fruitful filter. A great many securities were available on the bargain counter. Investing amid plunging prices and significant economic uncertainty, when others were fearing there was worse to come, might have seemed risky, but actually conferred a favorable ratio of reward to risk for those intrepid enough to buy in. However, most of the time the economy is not in depression, and relatively few securities meet the strict Graham and Dodd criteria. An investor focusing solely on buying what they called net nets, companies trading for less than the value of their working capital net of all liabilities, would be ignoring a vast universe of potential and likely more attractive opportunities in higher quality businesses with better growth prospects. As with anyone following an overly narrow approach, investors must have an answer to the question, what do you do when there's nothing to do? Investment approaches should be built not just to navigate one moment in time, but to be relevant all the time. We must consider the opportunity to buy common stocks for less than the liquidation value of the underlying companies to be a rare aberration, one to be found only sporadically and at a small number of companies. Even if such valuations were found, we would need to be circumspect about whether the approach would bear fruit. The companies such a screen might reveal are likely to be those with significant problems and uncertain long-term viability. In today's economy, they are less likely to be hidden gems than deeply troubled enterprises. Meanwhile, the ideas and tools for analyzing companies have been dramatically expanded. Investors, whether individuals or institutions, no longer depend on a slide rule or rudimentary calculator. They can rely on powerful Bloomberg terminals and desktop computers. Analyzing a company solely by its published financial statements confers no evident edge. To invest successfully amid deep-pocketed and technologically enabled competitors, investors must have an approach involving some sort of differentiated view or unique sourcing capability, and analyzing corporate balance sheets is unlikely to provide unique insights. Similarly, running a screen to identify companies trading below apparent liquidation value confers no apparent edge because everyone can do that, and as a result, stocks don't often become and stay egregiously mispriced the way they may have many decades ago. Where balance sheet analysis falls short. A company is much more than the numbers on its financial statements. These days, the volume of public information and the analytical tools available to assess that information are truly extraordinary. Legions of Wall Street analysts focus intensely on the quality of businesses. They have developed sophisticated, albeit far from perfect, models for projecting near-term growth, profit margins, and cash flows. Managements are no longer inaccessible, nor can they speak only to favored shareholders. Indeed, most CEOs and CFOs of publicly traded companies hold quarterly earnings calls with shareholders, provide forecasts, and offer in-depth investor days. They also go on roadshows to meet with investors in advance of large secondary offerings, spin-offs, and IPOs. Meanwhile, investment analysts use expert networks to gain insights into a company, its competitors, and its industry. Every investor is able to instantaneously call up financial statements for thousands of companies. Wall Street research reports on thousands of publicly traded firms are also readily available. Widely disseminated information confers no particular edge unless it is analyzed in differentiated ways. Unique sources of information are hard to come by in a highly competitive world. The intensified competition for investment insights makes it crucial for investors to consistently exhibit deep humility. The irony of the information age is that you can know more than you ever did before, and perhaps more than anyone ever did before, yet that wealth of information is less useful now because it confers upon you no particular edge. Everybody knows what you know. Indeed, a naive approach based solely on using company financials to screen for opportunity could well be a sucker bet. Warren Buffett often notes that investing can be like playing poker in one important sense. At a poker table, if you look to your left and to your right and you can't identify the patsy, the mark, the rube who has been invited to the game by the more experienced players, then it's probably you. Every investor should be worried by that thought and should work assiduously to never find themselves in that position. Even if you could find shares in overlooked companies available below likely liquidation value, benefiting from their mispricing has become far from a sure thing because liquidation value has become increasingly murky. Companies are not easily or frequently liquidated. All liabilities, including off-balance sheet and contingent ones, must be extinguished before liquidation proceeds are distributed to shareholders whose interests are subordinated. Rent must be paid under leases that may extend well into the future. Employees may have been promised deferred compensation or termination benefits. Products may have extended warranties. Underfunded pension plans must be funded. Also, many companies that seem potentially discounted based on balance sheet analysis have a cash burn rate until the time that they achieve a future profitability. This especially applies to many of the smaller technology companies and biotech startups that may have prematurely come public in the euphoric environment of 2020 to 2021. For such companies, cash on hand today may not be available for shareholders tomorrow if it is spent on research and development, customer acquisition, new facilities, or acquisitions. Another pitfall for investors overly focused on book value is that financial accounting standards are far from perfect. At best, they are an approximation that, like an impressionist painting, can give a sense of reality without being reality. Accounting is a bit like throwing a dart from the far side of a room. You almost certainly won't hit the bullseye, and you may not even hit the target. Hopefully, you'll be close enough, but sometimes you won't be. One of the many difficulties associated with accounting principles is that they provide a snapshot of a company's finances at a fixed point in time. But things change. Companies may have inventories that are subject to rapid obsolescence, receivables that have become uncollectible, and plant and equipment that have become increasingly inefficient, outmoded, or obsolete. Some firms may have large off-balance sheet liabilities resulting from environmental damage, product defects, or ongoing litigation. On the other side of the ledger, some companies hold hidden assets, such as real estate that has appreciated far above amortized cost, ownership interest in an increasingly valuable fast-growing subsidiary, or a significantly overfunded pension plan. The effects of sustained inflation over time have also wreaked havoc with the accuracy of assets accounted for using historic cost accounting. Consequently, two companies owning identical assets could report very different book values. Accounting is, of course, still very useful in the big picture. An approximation is obviously better than no information at all. Also, in some countries, accounting standards are less than rigorous, and investors would be wise to be even more skeptical than usual about the reported numbers. It pays to verify that the auditor is highly credible. The job of investors is not to simply accept the GAAP numbers, but rather to question and continuously refine them to achieve greater and greater accuracy. Another accounting challenge investors face in using book value as a means of estimating business value is the impact of share buybacks over time. Accounting standards adjust shareholders' equity down for the cost of stock repurchases, meaning that a very profitable company that regularly buys back shares with free cash flow may have a low or even negative stated book value. Accounting principles for companies that execute large share repurchases over time can easily yield a misleading result. The whole point of forming a company is to build an enterprise that is worth much more than the sum of its parts. The goal is to grow value to a level far above book value, significantly eclipsing the cost of the physical assets held by the business. The present value of the cash flows generated by a successful business will significantly exceed the cost of forming and building it, ideally by a very substantial margin. Value is, of course, created when a business offers a reliable product or service at a reasonable price that meets the needs and aspirations of its customers. The value of a business above the balance sheet value of its hard assets can be thought of as goodwill. Not the financial statement goodwill sometimes booked in a takeover, but the general conversational definition of goodwill, that is, the positive feelings or goodwill that a company has engendered among its customers, suppliers, and other stakeholders as expressed through loyalty, trust, and symbiotic relationships. Another problem with focusing on book value is that it is often embodied by an industrial model that has been significantly disrupted by technology. The book value of large manufacturing companies is of necessity substantial, a measure of the resources necessary to be in such businesses. But some of the best businesses in the world have been formed since the advent of the Internet, and many are asset light. They outsource manufacturing and other activities. They rent rather than own assets. Their products are intellectual property such as computer software. For such businesses, book value is essentially irrelevant. Their business value is considerably greater than the hard assets they own. Some companies are able to build increasingly wide moats around their businesses as a result of accumulating more and more data from their customers, creating a valuable network effect whereby today's commercial success leads to tomorrow's even greater competitive advantage. Today, when a company loses its edge and comes under increased competitive threat, often because of technological disruption, the downside comes suddenly and relentlessly. With so many stocks trading at a hefty premium to book value, many for good reason, there is a long way to fall before the value of hard assets cushions the downside. These days, the small number of businesses trading at very depressed levels at which the book value or liquidation value exceeds the share price, are likely to be those with commensurately less upside potential and inferior business models. Thus, book value is no longer a screen for attractive opportunity, but instead for its opposite. The book value of a company that cannot generate cash flow is necessarily suspect, as are its component parts, inventory, receivables, and plant and equipment. But wait, for certain businesses, it should be noted, book value does remain quite relevant. Regulated businesses such as utilities are entitled to a statutory return on capital, and most utilities trade in a reasonably narrow valuation range as a result. Banks and insurance companies are required by regulators to have a certain ratio of shareholder capital at risk compared to the size of the business. While some have created more enduring business moats than others, book value is a more relevant metric for financial institutions than for most other businesses if, and this is a big if, the assets on the balance sheet of those firms are worth at least their reported carrying value. The most useful aspects of balance sheet analysis. While book value has become considerably less relevant than in the past, nonetheless, balance sheet analysis remains a highly valuable and necessary practice for all investors. A company's balance sheet can be an indicator of its financial health and even prosperity. Companies with limited debt are said to have a clean balance sheet and usually significant borrowing capacity and reserve, which confers operating and strategic flexibility. On the other hand, a highly leveraged balance sheet offers less flexibility while raising the prospect of looming debt maturities that must be met. A heavily indebted company runs into trouble quickly when the economy turns down and its operating performance stumbles. That may launch a spiral in which maturing debt must be refinanced at increasingly higher cost, causing interest expense to gobble up a growing portion of corporate cash flow. Balance sheet analysis will always be a useful tool to an investor in financially distressed or bankrupt companies. It remains an essential element in understanding the hierarchy of claims on the company's assets and determining the value of a business. Equity investors bear the risk that a downturn in business results could drive the need for dilutive share issuance at discounted prices. Corporate managements regularly seek to optimize their balance sheets. Holding too much cash and other liquid assets lowers the return on invested capital. On the other hand, holding insufficient liquidity could cause a business to be vulnerable to sudden economic or market shocks. A company with a clean balance sheet has more degrees of freedom than a highly leveraged one. Finally, a balance sheet can provide clues to a company's underlying business performance. It's important to be able to identify red flags. Are the reported earnings consistent with the free cash flow generated by a company? Are the days it takes to collect on receivables or the number of days that inventory is held longer than in the past? Are liabilities growing faster than the business is? Investors will want to conduct such analyses before taking a position. Graham and Dodd's emphasis on book value may have been supplanted by newer metrics, but their focus on balance sheet analysis remains valid. Balance sheet scrutiny is a necessary, though not sufficient, step in analyzing investments. A successful investor should always delve into the smallest balance sheet details in order to ferret out clues as to the true merits of a business and the challenges facing it. No matter how robust an investor's models and algorithms may be, it always pays to read the footnotes. Chapter 42. Balance Sheet Analysis, Significance of Book Value. On numerous occasions prior to this point, we have expressed our conviction that the balance sheet deserves more attention than Wall Street has been willing to accord it for many years past. By way of introduction to this section of our work, let us list 5 types of information and guidance that the investor may derive from a study of the balance sheet. 1. It shows how much capital is invested in the business. 2. It reveals the ease or stringency of the company's financial condition, that is, the working capital position. 3. It contains the details of the capitalization structure. 4. It provides an important check upon the validity of the reported earnings. 5. It supplies the basis for analyzing the sources of income. In dealing with the first of these functions of the balance sheet, we shall begin by presenting certain definitions. The book value of a stock is the value of the assets applicable thereto as shown in the balance sheet. It is customary to restrict this value to the tangible assets, that is, to eliminate from the calculation such items as goodwill, trade names, patents, franchises, leaseholds. The book value is also referred to as the asset value, and sometimes as the tangible asset value, to make clear that intangibles are not included. In the case of common stocks, it is also frequently termed the equity. Computation of book value. The book value per share of a common stock is found by adding up all the tangible assets, subtracting all liabilities and stock issues ahead of the common, and then dividing by the number of shares. In many cases, the following formula will be found to furnish a shortcut to the answer. Book value per share of common equals common stock plus surplus items minus intangibles divided by number of shares outstanding. By surplus items are meant not only items clearly marked as surplus, but also premiums on capital stock and such reserves as are really part of the surplus. This would include, for example, reserves for preferred stock retirement, for plant improvement, and for contingencies, unless known to be actually needed. Reserves of this character may be termed voluntary reserves. Calculation of book value of United States Steel Common on December 31, 1938. Condensed balance sheet December 31, 1938 in millions. Assets: 1. Property investment account, less depreciation, 1,166. 2. Mining royalties, 9. 3. Deferred charges. 4. Miscellaneous investments, 19. 5. Miscellaneous other assets, 3. 6. Current assets, 510. Total, 1,711. Liabilities: 7. Common stock, 653. 8. Preferred stock, 360. 9. Subsidiary stocks publicly held, 5. 10. Bonded debt, 232. 11. Mining royalty notes, 12. 12. Current liabilities, 79. 13. Contingency and other reserves, 39. 14. Insurance reserves, 46. 15. Capital surplus, 38. 16. Earned surplus, 247. Total liabilities, 1,711. Tangible assets, $1,711,000,000. Less all liabilities ahead of common, sum of items 8 through 12, $688 million. Net assets for common stock, $1,023,000,000. Book value per share on 8,700,000 shares, $117.59. The alternative method of computation, which is usually shorter than the foregoing, is as follows. Common stock, $653 million. Surplus and voluntary reserves, sum of items 13 through 16, $370 million. Net assets for common stock, $1,023,000,000. Treatment of preferred stock when calculating book value of common. In calculating the assets available for the common stock, care must be taken to subtract preferred stock at its proper valuation. Ordinarily, this will be the par or stated value of the preferred stock as it appears in the balance sheet. But there is a growing number of cases in which preferred stock is carried in the balance sheet at arbitrary values far lower than the real liability attaching thereto. Island Creek Coal Company has a preferred stock of $1 par, which is entitled to annual dividends of $6 and to $120 per share in the event of dissolution. In 1939, the price of this issue ruled about $120. In the calculation of the asset value of Island Creek Coal Common, the preferred stock should be deducted not at $1 per share, but at $100 per share, its true or effective par, or else at $120. Capital Administration Company Limited, an investment trust, has outstanding preferred stock entitled to $3 cumulative dividends and to $50 or $55 in liquidation, but its par value is $10. It also has a Class A stock entitled to $20 in liquidation, plus 70% of the assets remaining, and to 70% of the earnings paid out after preferred dividends, but the par value of this issue is $1. Finally, it has Class B stock, par 1 cent, entitled to the residue of earnings and assets. Obviously, a balance sheet set up on the basis of par value is worse than meaningless in this case, and it must be corrected by the analyst somewhat as follows. This sheet may be found in the accompanying PDF. Coca-Cola Company has outstanding a no-par Class A stock entitled to preferential dividends of $3 per share cumulative and redeemable at $55. The company carries this issue as a liability at its stated value of $5 per share, but the true par value is clearly $50. In all instances such as the above, an effective par value must be set up for the preferred stock that will correspond properly to its dividend rate. A strong argument may be advanced in favor of valuing all preferred stocks on a uniform dividend basis, say 5%, unless callable at a lower figure. This would mean that a $1 million 5% issue would be valued at $1 million. A $1 million 4% issue would be given an effective value of $800,000, and a $1 million 7% non-callable issue would be given an effective value of $1,400,000. But it is more convenient, of course, to use the par value, and in most cases the result will be sufficiently accurate. A simpler method, which would work well for most practical purposes, is to value preferred issues at par, plus back dividends, or market, whichever is higher. Calculation of book value of preferred stocks. In calculating the book value of a preferred stock issue, it is treated as a common stock, and the issues junior to it are left out of consideration. The following computations from the December 31st, 1932 balance sheet of Tubize Chatillon Corporation, found in the accompanying PDF, will illustrate the principles involved. The reserve for depreciation and miscellaneous purposes was very large and might have included arbitrary allowances belonging in surplus. But in the absence of details, a reserve of this kind must be deducted from the assets. It later transpired that a substantial part of the reserve was needed to absorb a write-off of plant abandoned owing to obsolescence. The book value of the second preferred stock is readily computed from the foregoing as follows. Net assets for first preferred, $9,676,000, less first preferred at par, $2,500,000. Net assets for second preferred, $7,176,000. Book value per share, $52.75. In computing the book value of the common, it would be an obvious error to deduct the second preferred at its non-representative par value of $1. The effective par should be taken at not less than $100 per share in view of the $7 dividend. Hence, there are no assets available for the common stock, and its book value is nil. Current asset value and cash asset value. In addition to the well-known concept of book value, we wish to suggest two others of similar character, viz. Current asset value and cash asset value. The current asset value of a stock consists of the current assets alone minus all liabilities and claims ahead of the issue. It excludes not only the intangible assets but the fixed and miscellaneous assets as well. The cash asset value of a stock consists of the cash assets alone, minus all liabilities and claims ahead of the issue. Cash assets, other than cash itself, are defined as those directly equivalent to and held in place of cash. They include certificates of deposit, call loans, marketable securities at market value, and cash surrender value of insurance policies. The following is an example of the computation of the three categories of asset value and may be found in the accompanying PDF. In these calculations, it will be noted, first, that the inventory is increased by restoring the reserve of $425,000 subtracted therefrom in the balance sheet. This is done because the deduction taken by the company is clearly a reserve for contingent decline in value that has not yet taken place. As such, it is entirely arbitrary or voluntary, and consistency of method would require the analyst to regard it as a surplus item. The same is true of the $210,000 reserve for equipment and other expenses, which, as far as can be seen, represents neither an actual liability nor a necessary deduction from the value of any specific asset. In June 1929, Otis Company common stock was selling at $35. The reader will observe an extraordinary divergence between this market price and the current asset value of the shares. Its significance will engage our attention later. Practical significance of book value. The book value of a common stock was originally the most important element in its financial exhibit. It was supposed to show the value of the shares in the same way as a merchant's balance sheet shows him the value of his business. This idea has almost completely disappeared from the financial horizon. The value of a company's assets as carried in its balance sheet has lost practically all its significance. This change arose from the fact, first, that the value of the fixed assets as stated frequently bore no relationship to the actual cost, and, secondly, that in an even larger proportion of cases these values bore no relationship to the figure at which they would be sold or the figure which would be justified by the earnings. The practice of inflating the book value of the fixed property is giving way to the opposite artifice of cutting it down to nothing in order to avoid depreciation charges. But both have the same consequence of depriving the book value figures of any real significance. It is a bit strange, like a quaint survival from the past, that the leading statistical services still maintain the old procedure of calculating the book value per share of common stock from many, perhaps most, balance sheets that they publish. Before we discard completely this time-honored conception of book value, let us ask if it may ever have practical significance for the analyst. In the ordinary case, probably not. But what of the extraordinary or extreme case? Let us consider the 4 exhibits shown on page 556, which may be found in the accompanying PDF, as representative of extreme relationships between book value and market price. No thoughtful observer could fail to be impressed by the disparities revealed in the examples given. In the case of General Electric and commercial solvents, the figures proclaim more than the bare fact that the market was valuing the shares at many times their book value. The stock ticker seems here to register an aggregate valuation for these enterprises that is totally unrelated to their standing as ordinary business enterprises. In other words, these are in no sense business valuations. They are products of Wall Street's legerdemain or possibly of its clairvoyance. Financial reasoning versus business reasoning. We have here the point that brings home more strikingly perhaps than any other the widened rift between financial thought and ordinary business thought. It is an almost unbelievable fact that Wall Street never asks, "How much is the business selling for?" Yet this should be the first question in considering a stock purchase. If a businessman were offered a 5% interest in some concern for $10,000, his first mental process would be to multiply the asked price by 20 and thus establish a proposed value of $200,000 for the entire undertaking. The rest of his calculation would turn about the question whether or not the business was a good buy at $200,000. This elementary and indispensable approach has been practically abandoned by those who purchase stocks. Of the thousands who invested in General Electric in 1929 to 1930, probably only an infinitesimal number had any idea that they were paying on the basis of about $2.5 billion for the company, of which over $2 billion represented a premium above the money actually invested in the business. The price of 57 established for commercial solvents in July 1933 was more of a gambling phenomenon induced by the expected repeal of prohibition. But the gamblers in this instance were acting no differently from those who call themselves investors in their blithe disregard of the fact that they were paying $140 million for an enterprise with about $10 million of resources. The fixed assets of commercial solvents, written down to nothing in the balance sheet, had real value, of course, but not in excess of a few millions. The contrast in the other direction shown by our examples is almost as impressive. A going but unsuccessful concern like Pennsylvania Coal and Coke can be valued in the market at about 1/16 of its stated resources, almost on the same day as a speculatively attractive issue is bid for at 16 times its net worth. The Pepperell example is perhaps more striking still because of the unquestioned reality of the figures of book value and also because of the high reputation, large earnings, and liberal dividends of the enterprise covering a long stretch of years. Yet part owners of this business, under the stress of depression, it is true, were willing to sell out their interest at 1/10 of the value that a single private owner would have unhesitatingly placed upon it. Recommendation. These examples, extreme as they are, suggest rather forcibly that the book value deserves at least a fleeting glance by the public before it buys or sells shares in a business undertaking. In any particular case, the message that the book value conveys may well prove to be inconsequential and unworthy of attention, but this testimony should be examined before it is rejected. Let the stock buyer, if he lays any claim to intelligence, at least be able to tell himself first what value he is actually setting on the business, and second, what he is actually getting for his money in terms of tangible resources. There are indeed certain presumptions in favor of purchases made far below asset value and against those made at a high premium above it. It is assumed that in the ordinary case the book figures may be accepted as roughly indicative of the actual cash invested in the enterprise. A business that sells at a premium does so because it earns a large return upon its capital. This large return attracts competition and, generally speaking, it is not likely to continue indefinitely. Conversely, in the case of a business selling at a large discount because of abnormally low earnings, the absence of new competition, the withdrawal of old competition from the field, and other natural economic forces may tend eventually to improve the situation and restore a normal rate of profit on the investment. Although this is orthodox economic theory and undoubtedly valid in a broad sense, we doubt if it applies with sufficient certainty and celerity to make it useful as a governing factor in common stock selection. It may be pointed out that under modern conditions, the so-called intangibles, for example, goodwill or even a highly efficient organization, are every whit as real from a dollars and cents standpoint as are buildings and machinery. Earnings based on these intangibles may be even less vulnerable to competition than those which require only a cash investment in productive facilities. Furthermore, when conditions are favorable, the enterprise with the relatively small capital investment is likely to show a more rapid rate of growth. Ordinarily, it can expand its sales and profits at slight expense and therefore more rapidly and profitably for its stockholders than a business requiring a large plant investment per dollar of sales. We do not think, therefore, that any rules may reasonably be laid down on the subject of book value in relation to market price, except the strong recommendation already made that the purchaser know what he is doing on this score and be satisfied in his own mind that he is acting sensibly. Chapter 43. Significance of the current asset value. The current asset value of a common stock is more likely to be an important figure than the book value, which includes the fixed assets. Our discussion of this point will develop the following theses. 1. The current asset value is generally a rough index of the liquidating value. 2. A large number of common stocks sell for less than their current asset value and therefore sell below the amount realizable in liquidation. 3. The phenomenon of many stocks selling persistently below their liquidating value is fundamentally illogical. It means that a serious error is being committed either A. in the judgment of the stock market, B. in the policies of the company's management, or C. in the attitude of the stockholders toward their property. Liquidating value. By the liquidating value of an enterprise, we mean the money that the owners could get out of it if they wanted to give it up. They might sell all or part of it to someone else on a going concern basis, or else they might turn the various kinds of assets into cash in piecemeal fashion, taking whatever time is needed to obtain the best realization from each. Such liquidations are of everyday occurrence in the field of private business. By contrast, however, they are very rare indeed in the field of publicly owned corporations. It is true that one company often sells out to another, usually at a price well above liquidating value, also that insolvency will at times result in the piecemeal sale of the assets. But the voluntary withdrawal from an unprofitable business, accompanied by the careful liquidation of the assets, is an infinitely more frequent happening among private than among publicly owned concerns. This divergence is not without its cause and meaning, as we shall show later. Realizable value of assets varies with their character. A company's balance sheet does not convey exact information as to its value in liquidation, but it does supply clues or hints which may prove useful. The first rule in calculating liquidating value is that the liabilities are real, but the value of the assets must be questioned. This means that all true liabilities shown on the books must be deducted at their face amount. The value to be ascribed to the assets, however, will vary according to their character. The following schedule, found in the accompanying PDF, indicates fairly well the relative dependability of various types of assets in liquidation. Calculation illustrated. The calculation of approximate liquidating value in a specific case is illustrated as follows. Example: White Motor Company. See the accompanying PDF for balance sheet information. Object of this calculation. In studying this computation, it must be borne in mind that our object is not to determine the exact liquidating value of White Motor, but merely to form a rough idea of this liquidating value in order to ascertain whether or not the shares are selling for less than the stockholders could actually take out of the business. The latter question is answered very definitely in the affirmative. With full allowance for possible error, there was no doubt at all, in 1931, that White Motor would liquidate for a great deal more than $8 per share, or $5,200,000 for the company. The striking fact that the cash assets alone considerably exceed this figure, after deducting all liabilities, completely clinched the argument on this score. Current asset value, a rough measure of liquidating value. The estimated values in liquidation as given for White Motor are somewhat lower in respect of inventories and somewhat higher as regards the fixed and miscellaneous assets than one might be inclined to adopt in other examples. We are allowing for the fact that motor truck inventories are likely to be less saleable than the average. On the other hand, some of the assets listed as non-current, in particular the investment in White Motor Securities Corporation, would be likely to yield a larger proportion of their book values than the ordinary property account. It will be seen that White Motor's estimated liquidating value, about $31 per share, was not far from the current asset value, $34 per share. In the typical case, it may be said that the non-current assets are likely to realize enough to make up most of the shrinkage suffered in the liquidation of the current assets. Hence our first thesis, viz., that the current asset value affords a rough measure of the liquidating value. Prevalence of stocks selling below liquidating value. Our second point is that for some years past, a considerable number of common stocks have been selling in the market well below their liquidating value. Naturally, the percentage was largest during the Depression, but even in the bull market of 1926 to 1929, instances of this kind were by no means rare. It will be noted that the striking case of Otis Company, presented in the last chapter, occurred during June 1929 at the very height of the boom. The Northern Pipeline example given in Chapter 41 dates from 1926. On the other hand, our Pepperell and White Motor illustrations were phenomena of the 1931 to 1933 collapse. It seems to us that the most distinctive feature of the stock market of those 3 years was the large proportion of issues which sold below their liquidating value. Our computations indicate that over 40% of all the industrial companies listed on the New York Stock Exchange were quoted at some time in 1932 at less than their net current assets. A considerable number actually sold for less than their cash asset value, as in the case of White Motor. On reflection, this must appear to be an extraordinary state of affairs. The typical American corporation was apparently worth more dead than alive. The owners of these great businesses could get more for their interest by shutting up shop than by selling out on a going concern basis. In the recession of 1937 to 1938, this situation was repeated on a smaller scale. Available data indicate that 20.5% of the industrial companies listed on the New York Stock Exchange sold in early 1938 at less than their net current asset value. At the close of 1938, when the general price level was by no means abnormally low, a total of 54 companies out of 648 industrials studied sold for less than their net current assets. It is important to observe that these widespread discrepancies between price and current asset value are a comparatively recent development. In the severe market depression of 1921, the proportion of industrial stocks in this class was quite small. Evidently, the phenomena of 1932 and 1938 were the direct outgrowth of the New Era doctrine, which transferred all the tests of value to the income account and completely ignored the balance sheet picture. In consequence, a company without current earnings was regarded as having very little real value, and it was likely to sell in the market for the merest fraction of its realizable resources. Most of the sellers were not aware that they were disposing of their interest at far less than its scrap value. Many, however, who might have known the fact would have justified the low price on the ground that the liquidating value was of no practical importance, since the company had no intention of liquidating. Logical significance of this phenomenon. This brings us to the third point, viz., the logical significance of this sub-liquidating value phenomenon from the standpoint of the market, of the managements, and of the stockholders. The whole issue may be summarized in the form of a basic principle, viz., when a common stock sells persistently below its liquidating value, then either the price is too low or the company should be liquidated. Two corollaries may be deduced from this principle. Corollary 1, such a price should impel the stockholders to raise the question whether or not it is in their interest to continue the business. Corollary 2, such a price should impel the management to take all proper steps to correct the obvious disparity between market quotation and intrinsic value, including a reconsideration of its own policies and a frank justification to the stockholders of its decision to continue the business. The truth of the principle above stated should be self-evident. There can be no sound economic reason for a stock's selling continuously below its liquidation value. If the company is not worth more as a going concern than in liquidation, it should be liquidated. If it is worth more as a going concern, then the stock should sell for more than its liquidating value. Hence, on either premise, a price below liquidating value is unjustifiable. Twofold application of foregoing principle. Stated in the form of a logical alternative, our principle invites a twofold application. Stocks selling below liquidation value are in many cases too cheap and so offer an attractive medium for purchase. We have thus a profitable field here for the technique of security analysis, but in many cases also the fact that an issue sells below liquidating value is a signal that mistaken policies are being followed and that therefore the management should take corrective action, if not voluntarily, then under pressure from the stockholders. Let us consider these two lines of inquiry in order. Attractiveness of such issues as commitments. Common stocks in this category practically always have an unsatisfactory trend of earnings. If the profits had been increasing steadily, it is obvious that the shares would not sell at so low a price. The objection to buying these issues lies in the probability, or at least the possibility, that earnings will decline or losses continue, and that the resources will be dissipated and the intrinsic value ultimately become less than the price paid. It may not be denied that this does actually happen in individual cases. On the other hand, there is a much wider range of potential developments which may result in establishing a higher market price. These include the following. 1. The creation of an earning power commensurate with the company's assets. This may result from A. General improvement in the industry, B. Favorable change in the company's operating policies with or without a change in management. These changes include more efficient methods, new products, abandonment of unprofitable lines, etc. 2. A sale or merger, because some other concern is able to utilize the resources to better advantage and, hence, can pay at least liquidating value for the assets. 3. Complete or partial liquidation. Examples of effective favorable developments on such issues. General improvement in the industry. Examples already given and certain others will illustrate the operation of these various kinds of favorable developments. In the case of Pepperell, the low price of $17.50 coincided with a large loss for the year ended June 30, 1932. In the following year, conditions in the textile industry improved. Pepperell earned over $9 per share and resumed dividends. Consequently, the price of the stock advanced to $100 in January 1934 and to $149.75 in 1936. Changes in operating policies. Hamilton Woolen Company, another example in the textile field, is a case of individual rather than of general improvement. For several years prior to 1928, the company had operated at substantial losses, which amounted to nearly $20 and $12 per share in 1926 and 1927, respectively. Late in 1927, the common stock sold at $13 per share, although the company had net current assets of $38.50 per share at that time. In 1928 and 1929, changes in management and in managerial policies were made. New lines of product and direct sales methods were introduced, and certain phases of production were reorganized. This resulted in greatly improved earnings, which averaged about $5.50 per share during the succeeding 4 years, and within a single year the stock had risen to a price of about $40. Sale or merger. The White Motor instance is typical of the genesis and immediate effect of a sale or merger as applied to an issue selling for less than liquidating value. The later developments, however, were quite unusual. The heavy losses of White Motor in 1930 to 1932 impelled the management to seek a new alignment. Studebaker Corporation believed it could combine its own operations with those of White to mutual advantage, and it was greatly attracted by White's large holdings of cash. Hence, in September 1932, Studebaker offered to purchase all White Motor stock, paying for each share as follows: $5 in cash, $25 in 10-year 6% notes of Studebaker Corporation, 1 share of Studebaker Common selling for about $10. It will be seen that these terms of purchase were based not on the recent market price of White, below $7 per share, but primarily upon the current asset value. White Motor shares promptly advanced to $27 and later sold at the equivalent of $31.50. An interesting example of the same kind, but of more recent date, is afforded by Standard Oil Company of Nebraska. The facts may be outlined as follows. Early in 1939, the stock was selling at about $6, representing a total valuation of $1 million for 161,000 shares, comprising the entire capitalization. The December 31, 1938 balance sheet is summarized in the appended table. Assets. Fixed and miscellaneous assets, net, $2,794,000. Cash assets, $1,155,000. Other current assets, $961,000, for a total of $4,910,000. Net cash assets per share, $6.07. Net current assets per share, $12.05. Net tangible assets per share, $29.33. Liabilities. Current liabilities, $176,000. Capital stock and surplus, $4,734,000. Total, $4,910,000. The company was engaged in the distribution of petroleum products in Nebraska. It was carrying on an annual business of some $5 million without appreciable profit. For the years 1935 to 1938, the reported earnings before depreciation averaged 69 cents per share. After expended depreciation, there was an average profit of 39 cents per share. And after depreciation as taken by the company, there was an average loss of 39 cents per share. Here was a company clearly selling for much less than liquidating value, the reason being its unsatisfactory earnings record. There was good reason to believe, however, that the company was really worth more than bare liquidating value, because the outlet it provided for gasoline, etc., would make its numerous retail and bulk stations a desirable acquisition for some large refining company. In April 1939, private interests offered to pay $12 per share for 66 2/3% of the outstanding stock. This bid failed of acceptance by a sufficient majority, but it was followed immediately by an offer to pay $17.50 per share, made by Standard Oil Company of Indiana, the refiner that had been supplying Standard Oil Company of Nebraska with its gasoline and that evidently was loath to lose this important outlet. The deal was promptly ratified, hence the stock of Standard Oil Company of Nebraska nearly tripled in value during a 4-month period in which the general market had suffered a decline. Complete liquidation. Mohawk Mining Company supplies an excellent example of a cash profit equivalent to a large advance in market value caused by the actual liquidation of the enterprise. In December 1931, the stock sold at $11 per share, representing a total valuation of $1,230,000 for the 112,000 shares outstanding. The balance sheet at the end of 1931 showed the following: cash and marketable securities at market, $1,381,000. Receivables, $9,000. Copper at market value, about $1,800,000. Supplies, $71,000. Total, $3,261,000. Less current liabilities, $68,000. Net current assets, $3,193,000. Fixed assets less depreciation and depletion, $2,460,000. Miscellaneous assets, $168,000. Total assets for common stock, $5,821,000. Book value per share, $52. Current asset value per share, $28.50. Cash asset value per share, $11.75. Market price per share, $11. Shortly thereafter, the management decided to liquidate the property. Within the years 1932 to 1934, regular and liquidating dividends were paid, aggregating $28.50 per share. It will be noted that the amount actually received in liquidation proved identical with the current asset value just before the liquidation began, and it was 2.5 times the ruling market price at that time. Partial liquidation. Northern Pipeline Company and Otis Company, already discussed, are examples of the establishment of a higher market value through partial liquidation. The two companies made the exhibits as shown in the table following, which may be found in the accompanying PDF. In September 1929, Otis Company paid a special dividend of $4 per share, and in 1930 it made a distribution of $20 in partial liquidation, reducing the par value from $100 to $80. In April 1931, the shares sold at $45, and in April 1932 at $41. These prices were higher than the quotation in June 1929, despite the distributions of $24 per share made in the interim, and despite the fact also that the general market level had changed from fantastic inflation to equally fantastic deflation. Later, the company went out of business altogether and paid its stockholders an additional $74 per share in liquidation, making the total received by them $102 per share since June 1929. inclusive of other dividends in 1929 through 1934, amounting to $4 per share. Northern Pipeline Company distributed $50 per share to its stockholders in 1928 as a return of capital, that is, partial liquidation. This development resulted in an approximate doubling of the market price between 1926 and 1928. Later, a second distribution of $20 per share was made, so that the stockholders received more in cash than in the low market price of 1925 and 1926, and they also retained their full interest in the pipeline business. Similar liberal distributions were made by most of the pipeline companies of the so-called Standard Oil Group. Discrimination required in selecting such issues. There is scarcely any doubt that common stocks selling well below liquidating value represent, on the whole, a class of undervalued securities. They have declined in price more severely than the actual conditions justify. This must mean that, on the whole, these stocks afford profitable opportunities for purchase. Nevertheless, the securities analyst should exercise as much discrimination as possible in the choice of issues falling within this category. He will lean toward those for which he sees a fairly imminent prospect of some one of the favorable developments listed above, or else he will be partial to such as reveal other attractive statistical features besides their liquid asset position, for example, satisfactory current earnings and dividends, or a high average earning power in the past. The analyst will avoid issues that have been losing their current assets at a rapid rate and show no definite signs of ceasing to do so. Examples. This latter point will be illustrated by the following comparison of two companies, found in the accompanying PDF, the shares of which sold well below liquidating value early in 1933. Both of these companies disclose an interesting relationship of current assets to market price at the close of 1932. But a comparison with the balance sheet situation of 3 years previously will yield much more satisfactory indications for Manhattan Shirt than for Hupp Motors. The latter concern had lost more than half of its cash assets and more than 60% of its net current assets during the Depression period. On the other hand, the current asset value of Manhattan Shirt Common was reduced by only 10% during these difficult times, and furthermore, its cash asset position was greatly improved. The latter result was obtained through the liquidation of receivables and inventories, the proceeds of which paid off the 1929 bank loans and largely increased the cash resources. From the viewpoint of past indications, therefore, the two companies must be placed in different categories. In the Hupp Motors case, we should have to take into account the possibility that the remaining excess of current assets over market price might soon be dissipated. This is not true so far as Manhattan Shirt is concerned, and in fact, the achievement of the company in strengthening its cash position during the Depression must be given favorable consideration. We shall recur later to this phase of security analysis, viz., the comparison of balance sheets over a period in order to determine the true progress of an enterprise. The former point, that attention should be paid also to the past earnings record, may be brought home by a brief comparison of two companies in early 1939. Refer to the chart found in the accompanying PDF. The losses of Pacific Mills did not have a serious effect upon the balance sheet position because they have come mainly out of the balance sheet via the depreciation allowance. But unless there were special reasons to expect a reversal of the operating results, the analyst would obviously prefer Eli and Walker as an investment purchase. Bargains of this type. Common stocks that 1. Are selling below their liquid asset value, 2. Are apparently in no danger of dissipating these assets, and 3. Have formerly shown a large earning power on the market price, may be said truthfully to constitute a class of investment bargains. They are indubitably worth considerably more than they are selling for, and there is a reasonably good chance that this greater worth will sooner or later reflect itself in the market price. At their low price, these bargain stocks actually enjoy a high degree of safety, meaning by safety, a relatively small risk of loss of principal. It may be pointed out, however, that investment in such bargain issues needs to be carried on with some regard to general market conditions at the time. Strangely enough, this is a type of operation that fares best, relatively speaking, when price levels are neither extremely high nor extremely low. The purchase of cheap stocks when the market as a whole seems much higher than it should be, for example in 1929 or early 1937, will not work out well because the ensuing decline is likely to bear almost as severely on these neglected or unappreciated issues as on the general list. On the other hand, when all stocks are very cheap, as in 1932, there would seem to be fully as much reason to buy undervalued leading issues as to pick out less popular stocks, even though these may be selling at even lower prices by comparison. A common stock representing the entire business cannot be less safe than a bond having a claim to only a part thereof. In considering these issues, it will be helpful to apply the converse of the proposition developed earlier in this book with reference to senior securities. We pointed out, Chapter 26, that a bond or preferred stock could not be worth more than its value would be if it represented full ownership of the company, that is, if it were a common stock without senior claims ahead of it. The converse is also true. A common stock cannot be less safe than it would be if it were a bond, that is, if instead of representing full ownership of the company, it were given a fixed and limited claim with some new common stock created to own what was left. This idea, which may appear somewhat abstract at first, may be clarified by a concrete comparison between a common stock and a bond issue of the types just described. Two companies in the investment trust field are particularly well suited to illustrate our point because they were both organized by the same banking interests and they have identical officers. Our table on page 572, found in the accompanying PDF, should make clear that Shawmut Association stock cannot be less safe intrinsically than the investment trust senior debentures at 85. For with the same management behind them, the stock investment has behind it 180% in assets, whereas the bonds are protected by only 122% of their market price in assets. In addition to having this greater protection, the association stock represents the entire ownership of the company's assets, whereas the interest of the investment trust bonds is limited to their principal amount, the balance of the equity belonging to the junior holders. In fact, this junior equity can be fairly substantial as measured by market price, even when the bonds are selling at a considerable discount. That the Shawmut Association stock is more attractive than the investment trust debentures at the prices quoted is scarcely open to challenge. Undoubtedly, also, the investor who would consider the bond issue to be safer than the association shares is being misled by the form into overlooking the essence. Yet something remains to be said of the effect of these diverse forms upon the experience of the investor and consequently upon his attitude. The investment trust bonds do carry a certain assurance of continued income because interest must be paid regularly or else the company faces insolvency. It is true for the same reason that special efforts will be made to pay them off at or before maturity in 1942 and 1952. Therefore, we find that the company has a special inducement to buy in bonds at a discount, since they must ultimately be paid at par, and thus 1/3 of the issue has been reacquired. This policy has served to maintain the market price to an important extent and to improve the position of the remaining bonds. None of this is true with respect to the Shawmut Association shares. They have in fact received continuous dividends since 1929, averaging 65 cents or 6.5% on the current price. But the rate has been variable, and the average stockholder feels that he is at the mercy of the management's decisions. This is not entirely so in fact, since the penalty clauses in the Revenue Act virtually compel disbursement of the net income realized by investment trusts. Nor has the market price been maintained by company repurchases at a reasonable discount from breakup value, so that the investor has been unable to look to the management to save him from the hard necessity of sacrificing his shares at as much as 50% below their intrinsic worth. In the 1934 edition, we illustrated this same point by considering American Laundry Machinery stock at its price of $7 in January 1933, which was equivalent to $4,300,000 for the entire company, as compared with over $4 million in cash, $21 million in net current assets, $27 million in net tangible assets, and 10-year average earnings of over $3 million, including, however, a loss of $1 million in 1932. The last two paragraphs of the chapter were as follows. Wall Street would have considered American Laundry Machinery stock unsafe at $7, but it would unquestionably have accepted a $4,500,000 bond issue of the same company. Its reasoning would have run that the interest on the bond was sure to be continued, but that the 40-cent dividend then being paid on the stock was very insecure. In one case, the directors had no choice but to pay interest and therefore would surely do so. In the other case, the directors could pay or not as they saw fit and therefore would very likely suspend the dividend. But Wall Street is here confusing the temporary continuance of income with a more fundamental question of safety of principle. Dividends paid to common stockholders do not in themselves make the stock any safer. The directors are merely turning over to the stockholders part of their own property. If the money were left in the Treasury, it would still be the stockholders' property. There must therefore be an underlying fallacy in assuming that if the stockholders were given the power to compel payment of income, that is, if they were made bondholders in whole or in part, their position would thus be made intrinsically sounder. It is little short of idiocy to assume that the stockholders would be better off if they surrendered their complete ownership of the company in exchange for a limited claim against the same property at the rate of 5 or 6% on the investment. This is exactly what the public would do if it were willing to buy a $4,500,000 bond issue of American Laundry Machinery, but would reject as unsafe the present common stock at $7 per share. Nevertheless, Wall Street persists in thinking in these irrational terms, and it does so in part with practical justification. Somehow or other, common stock ownership does not seem to give the public the same powers and possibilities, the same values, in short, as are vested in the private owners of a business. This brings us to the second line of reasoning on the subjects of stocks selling below liquidating value. Chapter 44. Implications of liquidating value. Stockholder management relationships. Wall Street holds that liquidating value is of slight importance because the typical company has no intention of liquidating. This view is logical as far as it goes. When applied to a stock selling below breakup value, the Wall Street view may be amplified into the following. Although this stock would liquidate for more than its market price, it is not worth buying because 1. The company cannot earn a satisfactory profit, and 2. It is not going to liquidate. In the previous chapter, we suggested that the first assumption is likely to be wrong in a number of instances, for, although past earnings may have been disappointing, there is always a chance that through external or internal changes, the concern may again earn a reasonable amount on its capital. But in a considerable proportion of cases, the pessimism of the market will at least appear to be justified. We are led, therefore, to ask the question, why is it that no matter how poor a corporation's prospects may seem, its owners permit it to remain in business until its resources are exhausted? The answer to this question takes us into the heart of one of the strangest phenomena of American finance, the relations of stockholders to the businesses that they own. The subject transcends in its scope the narrow field of security analysis, but we shall discuss it here briefly because there is a distinct relationship between the value of securities and the intelligence and alertness of those who own them. The choice of a common stock is a single act. Its ownership is a continuing process. Certainly, there is just as much reason to exercise care and judgment in being as in becoming a stockholder. Typical stockholder, apathetic and docile. It is a notorious fact, however, that the typical American stockholder is the most docile and apathetic animal in captivity. He does what the board of directors tell him to do and rarely thinks of asserting his individual rights as owner of the business and employer of its paid officers. The result is that the effective control of many, perhaps most, large American corporations is exercised not by those who together own a majority of the stock, but by a small group known as the management. This situation has been effectively described by Burrell and Means in their significant work, The Modern Corporation and Private Property. In Chapter 1 of Book 4, the authors say, "It is traditional that a corporation should be run for the benefit of its owners, the stockholders, and that to them should go any profits which are distributed. We now know, however, that a controlling group may hold the power to divert profits into their own pockets. There is no longer any certainty that a corporation will in fact be run primarily in the interests of the stockholders. The extensive separation of ownership and control and the strengthening of the powers of control raise a new situation calling for a decision whether social and legal pressure should be applied in an effort to ensure corporate operation primarily in the interests of the owners, or whether such pressure shall be applied in the interests of some other or wider group." Again, on page 335, the authors restate this view in their concluding chapter as follows. A third possibility exists, however. On the one hand, the owners of passive property, by surrendering control and responsibility over the active property, have surrendered the right that the corporation should be operated in their sole interests. They have released the community from the obligation to protect them to the full extent implied in the doctrine of strict property rights. At the same time, the controlling groups, by means of the extension of corporate powers, have, in their own interest, broken the bars of tradition, which require that the corporation be operated solely for the benefit of the owners of passive property. Eliminating the sole interest of the passive owner, however, does not necessarily lay a basis for the alternative claim that the new powers should be used in the interest of the controlling groups. The latter have not presented, in acts or words, any acceptable defense of the proposition that these powers should be so used. No tradition supports that proposition. The control groups have, rather, cleared the way for the claims of a group far wider than either the owners or the control. They have placed the community in a position to demand that the modern corporation serve not alone the owners or the control, but all society. Plausible but partly fallacious assumptions by stockholders. Alert stockholders, if there are any such, are not likely to agree fully with the conclusion of Messrs. Burrell and Means that they definitely have surrendered the right that the corporation should be operated in their sole interest. After all, the American stockholder has abdicated not intentionally but by default. He can reassert the rights of control that inhere in ownership. Quite probably he would do so if he were properly informed and guided. In good part, his docility and seeming apathy are results of certain traditional but unsound viewpoints which he seems to absorb by inheritance or by contagion. These cherished notions include the following. 1. The management knows more about the business than the stockholders do, and therefore its judgment on all matters of policy is to be accepted. 2. The management has no interest in or responsibility for the prices at which the company's securities sell. 3. If a stockholder disapproves of any major policy of the management, his proper move is to sell his stock. Assumed wisdom and efficiency of management not always justified. These statements sound plausible, but they are in fact only half-truths, the more dangerous because they are not wholly false. It is nearly always true that the management is in the best position to judge which policies are most expedient. But it does not follow that it will always either recognize or adopt the course most beneficial to the shareholders. It may err grievously through incompetence. Stockholders of any given company appear to take it for granted that their management is capable. Yet the art of selecting stocks is said to turn largely on choosing the well-managed enterprise and rejecting others. This must imply that many companies are poorly directed. Should not this mean also that the stockholders of any company should be open-minded on the question whether its management is efficient, or the reverse? Interests of stockholders and officers conflict at certain points. But a second reason for not always accepting implicitly the decisions of the management is that on certain points the interests of the officers and the stockholders may be in conflict. This field includes the following. 1. Compensation to officers, comprising salaries, bonuses, options to buy stock. 2. Expansion of the business, involving the right to larger salaries and the acquisition of more power and prestige by the officers. 3. Payment of dividends. Should the money earned remain under the control of the management or pass into the hands of the stockholders? 4. Continuance of the stockholders' investment in the company. Should the business continue as before, although unprofitable, or should part of the capital be withdrawn, or should it be wound up completely? 5. Information to stockholders. Should those in control be able to benefit through having information not given to stockholders generally? On all of these questions, the decisions of the management are interested decisions, and for that reason they require scrutiny by the stockholders. We do not imply that corporate managements are not to be trusted. On the contrary, the officers of our large corporations constitute a group of men above the average in probity as well as in ability. But this does not mean that they should be given carte blanche in all matters affecting their own interests. A private employer hires only men he can trust, but he does not let these men fix their own salaries or decide how much capital he should place or leave in the business. Directors not always free from self-interest in connection with these matters. In publicly owned corporations, these matters are passed on by the board of directors, whom the stockholders elect and to whom the officials are responsible. Theoretically, the directors will represent the stockholders' interests when need be, as against the opposing interests of the officers. But this cannot be counted upon in practice. In many companies, a majority, and in most companies, a substantial part of the board is composed of paid officials. The directors who are not officers are frequently joined by many close ties to the chief executives. It may be said, in fact, that the officers choose the directors more often than the directors choose the officers. Hence, the necessity remains for the stockholders to exercise critical and independent judgments on all matters where the personal advantage of the officers may conceivably be opposed to their own. In other words, in this field, the usual presumption of superior knowledge and judgment on the part of the management should not obtain, and any criticism offered in good faith deserves careful consideration by the stockholders. Abuse of managerial compensation. Numerous cases have come to light in which the actions of the management in the matter of its own compensation have been open to serious question. Most of these relate to the years before 1933. In the case of Bethlehem Steel Corporation, cash bonuses clearly excessive in amount were paid. In the case of American Tobacco Company, rights to buy stock below the market price of an enormous aggregate value were allotted to the officers. These privileges to buy stock are readily subject to abuse. In the case of Electric Bond and Share Company, the management permitted itself to buy many shares of stock at far below market price. When later the price of the stock collapsed to a figure less than the subscription price, the obligation to pay for the shares was canceled, and the sums already paid were returned to the officers. A similar procedure was followed in the case of White Motor Company, which will be more fully discussed later in this chapter. Some of these transactions are explained and partly justified by the extraordinary conditions of 1928 to 1932. Others are inexcusable from any point of view. Nevertheless, human nature being what it is, such developments are not in the least surprising. They do not really reflect upon the character of corporate managements, but rather on the patent unwisdom of leaving such matters within the virtually uncontrolled discretion of those who are to benefit by their own decisions. The new regulations have done much to dispel the mist of secrecy that formerly shrouded the emoluments and stock holdings of corporate officials. Information on salaries, bonuses, and stock options must be filed in connection with new security offerings, with the registration of issues on a national exchange, with the subsequent annual reports to the Commission, and with the solicitation of proxies. Although these data are not complete, they are sufficient for the practical purpose of advising the stockholders as to the cost of their management. Similarly, stock holdings of officers, directors, and those owning 10% of a stock issue must be revealed monthly. Since this information is not too readily accessible to the individual stockholder, the statistical agencies could further improve their already excellent service by subjoining the salary and stockholding data to their annual lists of officers and directors. In recent years, the question of excessive compensation to management has excited considerable attention, and the public understands fairly well that here is a field where the officers' views do not necessarily represent the highest wisdom. It is not so clearly realized that to a considerable extent the same limitations apply in matters affecting the use of the stockholders' capital and surplus. We have alluded to certain aspects of this subject in our discussion of dividend policies, Chapter 29. It should be evident also that the matter of raising new capital for expansion is affected by the same reasoning as applies to the withholding of dividends for this purpose. Wisdom of continuing the business should be considered. A third question, viz., that of retaining the stockholders' capital in the business, involves considerations that are basically identical. Managements are naturally loath to return any part of the capital to its owners, even though this capital may be far more useful and therefore valuable outside of the business than in it. Returning a portion of the capital, for example, excess cash holdings, means curtailing the resources of the enterprise, perhaps creating financial problems later on, and certainly reducing somewhat the prestige of the officers. Complete liquidation means the loss of the job itself. It is scarcely to be expected, therefore, that the paid officers will consider the question of continuing or winding up the business from the standpoint solely of what is in the best interests of the owners. We must emphasize again that the directors are often so closely allied with the officers, who are themselves members of the board, that they too cannot be counted upon to consider such problems purely from the stockholders' point of view. Thus it appears that the question whether or not a business should be continued is one that at times may deserve independent thought by its proprietors, the stockholders. It should be pointed out also that this is, by its formal or legal nature, an ownership problem and not a management problem. And a logical reason for devoting thought to this question would arise precisely from the fact that the stock has long been selling considerably below its liquidating value. After all, this situation must mean that either the market is wrong in its valuation, or the management is wrong in keeping the enterprise alive. It is altogether proper that the stockholders should seek to determine which of these is wrong. In this determination, the views and explanations of the management deserve the most appreciative attention, but the whole proceeding would be stultified if the management's opinion on this subject were to be accepted as final per se. It is an unhappy fact that in many cases where a management's policies are attacked, the critic has some personal axe to grind. This, too, is perhaps inevitable. There is very little altruism in finance. Wars against corporate managements take time, energy, and money. It is hardly to be expected that individuals will expend all these merely to see the right thing done. In such matters, the most impressive and creditable moves are those made by a group of substantial stockholders, having an important stake of their own to protect and impelled thereby to act in the interest of the shareholders generally. Representations from such a source in any matter where the interest of the officers and the owners may conceivably be opposed should gain a more respectful hearing from the rank and file of stockholders than has hitherto been accorded them in most cases. Broadcast criticisms initiated by stockholders, proxy battles, and various kinds of legal proceedings are exceedingly vexatious to managements, and in many cases they are unwisely or improperly motivated. Yet these should be regarded as one of the drawbacks of being a corporate official and as part of the price of a vigilant stock ownership. The public must learn to judge such controversies on their merits as developed by statements of fact and by reasoned argument. It must not allow itself to be swayed by mere accusation or by irrelevant personalities. The subject of liquidation must not be left without some reference to the employee's vital interest therein. It seems heartless in the extreme to discuss such a decision solely from the standpoint of what will be best for the stockholder's pocketbook. Yet nothing is to be gained by confusing the issue. If the reason for continuing the business is primarily to keep the workers employed, and if this means a real sacrifice by the owners, they are entitled to know and to face the fact. They should not be told that it would be unwise for them to liquidate, when in truth it would be profitable but inhumane. It is fair to point out that under our present economic system, the owners of a business are not expected to dissipate their capital for the sake of continuing employment. In privately owned enterprises, such philanthropy is rare. Whether or not a sacrifice of capital for this purpose is conducive to the economic welfare of the country as a whole is a moot point also, but it is not within our province to discuss it here. Our object has been to clarify the issue and to stress the fact that a market price below liquidating value has special significance to the stockholders and should lead them to ask their management some searching questions. Management may properly take some interest in market price for shares. Managements have succeeded very well in avoiding these questions with the aid of the time-honored principle that market prices are no concern or responsibility of theirs. It is true, of course, that a company's officers are not responsible for fluctuations in the price of its securities, but this is very far from saying that market prices should never be a matter of concern to the management. This idea is not only basically wrong, but it has the added vice of being thoroughly hypocritical. It is wrong because the marketability of securities is one of the chief qualities considered in their purchase. But marketability must presuppose not only a place where they can be sold, but also an opportunity to sell them at a fair price. It is at least as important to the stockholders that they be able to obtain a fair price for their shares as it is that the dividends, earnings, and assets be conserved and increased. It follows that the responsibility of managements to act in the interest of their shareholders includes the obligation to prevent, insofar as they are able, the establishment of either absurdly high or unduly low prices for their securities. It is difficult not to lose patience with the sanctimonious attitude of many corporate executives who profess not even to know the market price of their securities. In many cases, they have a vital personal interest in these very market prices, and at times they use their inside knowledge to take advantage in the market of the outside public and of their own stockholders. Not as a startling innovation, but as a common-sense recognition of things as they are, we recommend that directors be held to the duty of observing the market price of their securities and of using all proper efforts to correct patent discrepancies, in the same way as they would endeavor to remedy any other corporate condition inimical to the stockholder's interest. Various possible moves for correcting market prices for shares. The forms that these proper efforts might take are various. In the first place, the stockholder's attention may be called officially to the fact that the liquidating, and therefore the minimum, value of the shares is substantially higher than the market price. If, as will usually be the case, the directors are convinced that continuance is preferable to liquidation, the reasons leading to this conclusion should at the same time be supplied. A second line of action is in the direction of dividends. A special endeavor should be made to establish a dividend rate proportionate at least to the liquidating value in order that the stockholders should not suffer a loss of income through keeping the business alive. This may be done even if current earnings are insufficient, provided there are accumulated profits and provided also the cash position is strong enough to permit such payments. A third procedure consists of returning to the stockholders such cash capital as is not needed for the conduct of the business. This may be done through a prorated distribution, accompanied usually by a reduction in par value, or through an offer to purchase a certain number of shares pro rata at a fair price. Finally, a careful consideration by the directors of the discrepancy between earning power and liquidating value may lead them to conclude that a sale or winding up of the enterprise is the most sensible corrective step, in which case they should act accordingly. Examples: Otis Company, 1929 to 1939. The course of action followed by the Otis Company management in 1929 to 1930 combined a number of these remedial moves. In July 1929, the president circularized the shareholders, presenting an intermediate balance sheet as of June 30th and emphasizing the disparity between the current bid price and the liquidating value. In September of that year, although earnings were no larger than before, dividend payments were resumed, a step permitted by the company's large cash holdings and substantial surplus. In 1930, a good part of the cash, apparently not needed in the business, was returned to the stockholders through the redemption of the small preferred issue and the repayment of $20 per share of common stock on account of capital. Subsequently, the company embarked on a policy of piecemeal liquidation, which resulted in a series of payments on capital account. From September 1929 to the final distribution in 1940, there was paid a total of $94 per share as return of capital, as well as $8 in the form of dividends. As we pointed out in our last chapter, these steps were highly effective in improving the status of the Otis stockholders during a period when most other issues were suffering a shrinkage in value, and ultimately gave them a far larger return than they were likely to receive through the continuance of the business. Hamilton Woolen Company. The history of this enterprise since 1926 is even more interesting in this connection because it suggests a model technique for the handling by directors of problems affecting the stockholders' investment. In 1927, continued operating losses had resulted in a market price well below liquidating value. There was danger that the losses might continue and wipe out the capital. On the other hand, there was a possibility of much better results in the future, especially if new policies were adopted. A statement of the arguments for and against liquidation was forwarded to the stockholders, and they were asked to vote on the question. They voted to continue the business with a new operating head, and the decision proved a wise one, since good earnings were realized and the price advanced above liquidating value. In 1934, however, the company again showed a large loss, occasioned in good part by serious labor difficulties. The management again submitted the question of liquidation to the stockholders, and this time a winding up of the business was voted. A sale of the business was promptly arranged, and the stockholders received somewhat more than the November 1934 current asset value. Particularly noteworthy were the details of the 1927 proceedings. The ultimate decision, to continue or to quit, was put up to the stockholders in whose province it lay. The management supplied information, expressed its own opinion, and permitted an adequate statement of the other side of the case. Other examples of voluntary liquidation. The subjoined partial list, which may be found in the accompanying PDF, will demonstrate an obvious but fundamental fact, viz., that the liquidation or sale of an unprofitable company holding substantial assets, particularly current, is almost certain to realize for the stockholders considerably more than the previously existing market price. The reason is, of course, that the market price is governed chiefly by the earnings, whereas the proceeds of liquidation depend upon the assets. Repurchase of shares pro rata from shareholders. The Hamilton Woolen management is also to be commended for its action during 1932 and 1933 in employing excess cash capital to repurchase pro rata a substantial number of shares at a reasonable price. This reversed the procedure followed in 1929 when additional shares were offered for subscription to the stockholders. The contraction in business that accompanied the Depression made this additional capital no longer necessary, and it was therefore a logical move to give most of it back to the stockholders, to whom it was of greater benefit when in their own pockets than in the treasury of the corporation. Abuse of shareholders through open market purchase of shares. During the 1930 to 1933 Depression, repurchases of their own shares were made by many industrial companies out of their surplus cash assets, but the procedure generally followed was open to grave objection. The stock was bought in the open market without notice to the shareholders. This method introduced a number of unwholesome elements into the situation. It was thought to be in the interest of the corporation to acquire the stock at the lowest possible price. The consequence of this idea is that those stockholders who sell their shares back to the company are made to suffer as large a loss as possible for the presumable benefit of those who hold on. Although this is a proper viewpoint to follow in purchasing other kinds of assets for the business, there is no warrant in logic or in ethics for applying it to the acquisition of shares of stock from the company's own stockholders. The management is the more obligated to act fairly toward the sellers because the company is itself on the buying side. But in fact, the desire to buy back shares cheaply may lead to a determination to reduce or pass the dividend, especially in times of general uncertainty. Such conduct would be injurious to nearly all the stockholders, whether they sell or not, and it is for that reason that we spoke of the repurchase of shares at an unconscionably low price as only presumably to the advantage of those who retained their interest. Example: White Motor Company. In the previous chapter, attention was called to the extraordinary discrepancy between the market level of White Motor stock in 1931 to 1932 and the minimum liquidating value of the shares. It will be instructive to see how the policies followed by the management contributed mightily to the creation of a state of affairs so unfortunate for the stockholders. White Motor Company paid dividends of $4 per share, 8%, practically from its incorporation in 1916 through 1926. This period included the Depression year 1921, in which the company reported a loss of nearly $5 million. It drew, however, upon its accumulated surplus to maintain the full dividend, a policy that prevented the price of the shares from declining below 29. With the return of prosperity, the quotation advanced to 72.5 in 1924 and 104.5 in 1925. In 1926, the stockholders were offered 200,000 shares at par, $50, increasing the company's capital by $10 million. A stock dividend of 20% was paid at the same time. Hardly had the owners of the business paid in this additional cash when the earnings began to shrink, and the dividend was reduced. In 1928, about $3 were earned, consolidated basis, but only $1 was dispersed. In the 12 months ending June 30, 1931, the company lost about $2,500,000. The next dividend payment was omitted entirely, and the price of the stock collapsed to 7.5. The contrast between 1931 and 1921 is striking. In the earlier year, the losses were larger, the profit and loss surplus was smaller, and the cash holdings far lower than in 1931. But in 1921, the dividend was maintained and the price thereby supported. A decade later, despite redundant holdings of cash and the presence of substantial undistributed profits, a single year's operating losses sufficed to persuade the management to suspend the dividend and permit the establishment of a grotesquely low market price for the shares. During the period before and after the omission of the dividend, the company was active in buying its own shares in the open market. These purchases began in 1929 under a plan adopted for the benefit of those filling certain managerial positions. By June 1931, about 100,000 shares had been bought in at a cost of $2,800,000. With the passing of the dividend, the officers and employees were relieved of whatever obligations they had assumed to pay for these shares, and the plan was dropped. In the next 6 months, aided by the collapse in the market price, the company acquired 50,000 additional shares in the market at an average cost of about $11 per share. The total holdings of 150,000 shares were then retired and canceled. These facts, thus briefly stated, illustrate the vicious possibilities inherent in permitting managements to exercise discretionary powers to purchase shares with the company's funds. We note first the painful contrast between the treatment accorded to the white motor managerial employees